All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another business cycle narrative that you can ignore. This is about a liquidity mechanism that is draining cash from the real economy right now, in real time, and it's killing small businesses at a pace we have not seen since the 2008 financial crisis. Between January and December 2025, over 52,000 small businesses filed for bankruptcy in the United States. That's a 34% increase from the previous year. But here's what the mainstream business media is not telling you. This is not about poor management. This is not about changing consumer preferences. This is about a structural liquidity drain that has severed the connection between small businesses and the credit system they depend on to survive. Regional banks, the institutions that provide 80% of all small business loans in this country, are pulling back. They're tightening lending standards, they're calling in credit lines, and they're doing it because their own balance sheets are under stress from commercial real estate losses and deposit flight that has not stopped since the Silicon Valley Bank collapse in March 2023. We are witnessing a slow-motion credit seizure in the small business sector. And what makes this different from 2008 is that it's happening without headlines, without bailouts, and without any policy response from the Federal Reserve or the Treasury. The system is letting small businesses die to preserve the banking system. And if you own a business, if you employ people, or if you have capital sitting in regional banks, you need to understand exactly what is happening and why waiting is no longer a neutral position. In the next 25 minutes, I'm going to walk you through the mechanics of this liquidity drain. I'm going to show you the historical parallels that prove this pattern is not new. And I'm going to give you the 3 asymmetric plays that allow you to not just protect your capital, but position yourself to acquire distressed assets at generational valuations. By the end of this video, you will have a framework that most small business owners will not see until they're filing Chapter 11. So stay locked in, because this is the kind of information that separates those who survive systemic stress from those who get wiped out by it. Before we dive into the current crisis, you need to understand the foundational framework that governs how liquidity flows through the economy. Most people think about business failure in terms of profitability. They think if you're making money, you're safe. But that is a fundamental misunderstanding of how businesses actually die. Businesses do not die from lack of profitability, they die from lack of liquidity. You can be profitable on paper and still go bankrupt if you cannot access cash to meet payroll, pay suppliers, or service debt. This is called the liquidity mismatch problem. And it's the silent killer of small businesses in every credit contraction in history. Here's how it works. A small business operates on thin margins and uneven cash flow. Revenue comes in on net 30 or net 60 terms from customers, but expenses, payroll, rent, supplier invoices are due immediately. To bridge that gap, businesses rely on credit. Either a business line of credit from a regional bank, a credit card, or invoice factoring. That credit is the oxygen that keeps the business alive between the time you deliver a service and the time you get paid. Now, when banks tighten credit, when they reduce credit lines, increase interest rates, or simply refuse to renew loans, that oxygen gets cut off. The business can still be generating revenue, it can still have a full order book, but without access to liquidity, it cannot operate. It defaults on obligations, it lays off workers, and it files for bankruptcy. Not because the business model failed, but because the credit mechanism failed. This is what's happening right now across the United States, and the scale of it is being deliberately obscured by the way the data is reported. The core thesis of this video is simple but critical. We are in the middle of a regional banking crisis that never resolved. It simply moved off the front page. The stress that killed Silicon Valley Bank, Signature Bank, and First Republic in 2023 did not disappear. It metastasized into the balance sheets of hundreds of smaller regional and community banks, and those banks are now quietly deleveraging by cutting off small business credit. This liquidity drain is creating a two-tier economy. Large corporations with access to capital markets and investment-grade credit can borrow at reasonable rates. Small businesses that depend on regional bank loans are being systematically starved of capital. And the result is a wave of bankruptcies that is accelerating, not slowing. If you understand this dynamic, you can see the asymmetric opportunity. Distressed business assets, commercial real estate at discounts, and hard money lending to creditworthy borrowers who have been cut off by traditional banks. But you have to move now, because once this becomes obvious, the window closes. Now let's turn to history, because the pattern we're seeing today is not new. It has happened twice in the last century with devastating consequences for those who did not recognize the warning signs. The first parallel is the banking panic of 1930 to 1933 during the Great Depression. Most people remember the stock market crash of 1929, but that was not the event that destroyed wealth. The real devastation came in the 3 years after the crash, when the banking system collapsed. Between 1930 and 1933, over 9,000 banks failed in the United States. These were not investment banks on Wall Street. These were community banks, savings and loans, and regional institutions that served Main Street. When those banks failed, they took the deposits of millions of Americans with them. But here's the critical detail that gets lost in the history books. Those bank failures were not random. They followed a specific sequence. First, banks that had loaned heavily into real estate and agriculture saw those loans go bad as asset prices collapsed. Second, as loan losses mounted, banks cut off new lending and called in existing loans to preserve capital. Third, businesses that depended on those credit lines could not operate and they defaulted, which created more loan losses for the banks. Fourth, depositors, seeing the stress, began withdrawing their money, which drained liquidity and forced banks to sell assets at fire sale prices. And fifth, the entire system seized, credit disappeared, businesses failed by the thousands, and the economy entered a deflationary spiral that lasted a decade. The investors and business owners who survived this period were the ones who recognized the pattern early. They moved their deposits out of stressed regional banks and into stronger institutions or into hard assets. They stopped relying on bank credit and raised capital from private lenders or sold equity. And they positioned themselves to buy distressed assets, farmland, equipment, entire businesses, at pennies on the dollar when the bankruptcies peaked. The lesson from the 1930s is that when the banking system is under stress, you cannot wait for the headlines to tell you it's a crisis. By the time it's on the front page, the exits are closed. You have to watch the leading indicators: loan growth, credit standards, bank deposit trends, and you have to act while you still have optionality. The second historical parallel is the savings and loan crisis of 1989 to 1992. This one is less well known, but it's even more relevant to what we're seeing today. In the 1980s, savings and loan institutions, which were the primary lenders to small businesses and real estate developers, made massive bets on commercial real estate. They loaned aggressively during the boom years of the mid-1980s. But when the economy slowed and real estate values started falling, those loans went bad. By 1989, hundreds of S&Ls were insolvent. The government created the Resolution Trust Corporation to take over failed institutions and liquidate their assets. Over the next 3 years, 747 savings and loans collapsed. And here's the key point. During that period, small businesses that depended on S&L credit lines were cut off. The RTC was not in the business of making new loans. They were liquidating assets. So small business owners who had relied on those relationships for working capital found themselves with no access to credit. Revenue was still coming in. Customers were still buying. But without liquidity, they could not operate. The result was a wave of small business bankruptcies that peaked in 1991 and 1992, 2 to 3 years after the S&L crisis started. The investors who made generational wealth during this period were the ones who understood the liquidation cycle. They raised private capital, they bought distressed real estate from the RTC at 30 to 50 cents on the dollar, and they acquired failing businesses with good operations but bad balance sheets. They restructured, recapitalized, and held through the recovery. And when the economy stabilized in the mid-1990s, those assets were worth multiples of what they paid. The lesson from the S&L crisis is that liquidity drains create asymmetric opportunities. But you have to have capital, you have to have patience, and you have to move before the distress becomes consensus. Now let's bring this into the present and break down exactly what is happening in the regional banking system right now. The stress started in March 2023 with the collapse of Silicon Valley Bank. SVB was not a traditional commercial bank. It was the bank for venture capital and tech startups. But the mechanism that killed it is the same mechanism that is stressing regional banks today. SVB held a large portfolio of long-duration treasury bonds and mortgage-backed securities that they bought when interest rates were near zero. When the Federal Reserve started raising rates aggressively in 2022 and 2023, the value of those bonds collapsed. SVB was not insolvent in the traditional sense. They had assets, but those assets were worth far less than the deposits they owed to customers. When depositors figured this out, they ran. Over $40 billion was withdrawn in a single day, and the bank failed. Signature Bank and First Republic followed the same pattern within weeks. Now here's what the Federal Reserve and the FDIC did not tell you. SVB was not unique. Hundreds of regional and community banks across the United States are holding the same underwater bond portfolios. According to the FDIC's own data, as of the fourth quarter of 2024, U.S. banks were sitting on over $500 billion in unrealized losses on their securities portfolios. These are not mark-to-market losses that show up on the income statement. These are hidden losses that only matter if the bank is forced to sell the bonds before maturity. But here's the problem. If depositors start withdrawing funds, if a bank faces a liquidity crisis, they have to sell those bonds. And the moment they do, those unrealized losses become real. The bank's capital gets wiped out, and they either fail or they have to raise expensive emergency capital. Regional banks know this, and their response has been to conserve capital by cutting off risky lending. Small business loans are considered risky because they have higher default rates than residential mortgages or auto loans. So banks are reducing credit lines, tightening underwriting standards, and in many cases simply refusing to renew loans when they mature. The data confirms this. According to the National Federation of Independent Business, the percentage of small business owners who reported that credit was harder to obtain rose from 6% in early 2022 to over 32% by late 2025. That is a five-fold increase. And it's happening at the same time that interest rates on small business loans have risen from an average of 4.5% to over 9%. So not only is credit harder to get, it's twice as expensive. For a small business operating on 5 to 10% profit margins, that increase in borrowing costs is the difference between break-even and bankruptcy. Now let's talk about the quiet mechanism that makes this even worse. And this is something most business owners do not understand until it's too late. When a regional bank tightens credit, they do not announce it publicly. They do not send out press releases. They simply start declining loan applications, reducing credit lines, and requiring more collateral. This happens one business at a time, one loan officer decision at a time. So from the outside, it looks like isolated cases. But in aggregate, it's a systemic pullback. The Federal Reserve tracks this through their Senior Loan Officer Opinion Survey. And the most recent data from the fourth quarter of 2025 shows that over 60% of banks reported tightening standards for commercial and industrial loans to small businesses. That is the highest level since the 2008 financial crisis. This is not a forecast. This is happening right now. And here's the cascade effect. When a small business loses access to its credit line, it has to cut costs immediately. That means laying off workers, delaying supplier payments, and reducing inventory. When it lays off workers, those workers lose income and they cut spending. When it delays supplier payments, those suppliers face their own cash flow stress. And when it reduces inventory, it buys less from wholesalers and manufacturers. This creates a contraction in economic activity that spreads through the entire supply chain. The business might survive for a few months by drawing down savings or selling assets, but if the credit line is not restored, it eventually runs out of runway. It defaults on obligations, and it files for bankruptcy. The bankruptcy data tells the story. In 2025, total business bankruptcy filings in the United States reached 52,983, up from 39,000 in 2024. That is a 36% year-over-year increase. And the trajectory is accelerating. In the first quarter of 2026 alone, we have already seen over 15,000 filings. If that pace continues, we are on track for over 60,000 bankruptcies this year. To put that in context, during the 2008 financial crisis, business bankruptcies peaked at just under 64,000. We are approaching that level. And we are doing it without a stock market crash, without a housing collapse, and without any of the dramatic headlines that accompanied 2008. This is a quiet crisis. And that makes it more dangerous because most people are not paying attention. Now let's break down the three asymmetric plays that this environment creates, because understanding the problem is only valuable if you can position yourself to benefit from the dislocation. The first asymmetric play is distressed business acquisition. When small businesses fail, their assets do not disappear. The equipment, the customer lists, the intellectual property, the trained workforce, all of that still exists. And in a bankruptcy, those assets get sold at liquidation prices. If you have capital and you understand how to underwrite a distressed business, you can acquire those assets at 20 to 40 cents on the dollar. The key is to focus on businesses that failed because of liquidity, not because of a broken business model. A restaurant that has strong revenue but could not access a credit line to cover seasonal cash flow gaps is a very different situation than a restaurant with a bad location and declining sales. The first is a liquidity problem. The second is a business problem. You want to buy the liquidity failures because those can be fixed with capital and restructuring. The mechanics are straightforward. You work with bankruptcy attorneys, you monitor court filings, and you bid on assets through the bankruptcy process. Or you approach the business owner before they file and offer to buy the business or recapitalize it in exchange for equity. This requires expertise. You need to understand balance sheets, you need to know how to value assets, and you need to move quickly because the best opportunities get snatched up fast. But the returns can be extraordinary. I'm talking about acquiring businesses for 1 to 2 times EBITDA that would trade at 5 to 7 times in a normal market. You restructure, you stabilize, and you either hold for cash flow or sell at a normalized multiple in 3 to 5 years. That's a 3 to 5 times return on invested capital. The second asymmetric play is hard money lending to creditworthy borrowers who have been cut off by banks. There are thousands of small business owners right now who have strong cash flow, solid customer bases, and profitable operations, but they cannot get a loan from a regional bank because the bank is tightening credit. These borrowers are desperate for capital, and they are willing to pay 12 to 18% interest with strong collateral because the alternative is bankruptcy. This is where private lenders, hard money funds, and individual investors with capital can step in. You are not competing with banks. You are filling the gap that banks have created by pulling back. The key is to underwrite conservatively. You want businesses with strong cash flow, tangible collateral, and a clear path to repayment. You want loan-to-value ratios of 50% or less, and you want personal guarantees from the business owner. If you structure the loans correctly, the default risk is manageable. And even if a borrower defaults, you take possession of the collateral, which you underwrote conservatively, so you're protected. The returns on hard money lending in this environment are 15 to 20% annually. And that's cash flow, not speculative appreciation. This is one of the safest high-yield plays available in a liquidity crisis. The third asymmetric play is physical gold and silver as a liquidity hedge and a store of value outside the banking system. This might seem disconnected from small business credit, but it's not. Here's the connection. Small business owners who lose access to credit are being forced to liquidate assets to raise cash. They're selling equipment, they're selling inventory, they're drawing down savings, and in many cases, they're pulling deposits out of regional banks because they no longer trust those institutions. Where does that cash go? Some of it goes into larger money center banks, some of it goes into short-term treasuries, but an increasing amount is going into physical gold and silver because business owners understand that liquidity is king in a crisis. And the most liquid asset that holds value across every economic cycle is physical precious metals. Gold and silver are not just inflation hedges, they are liquidity hedges. When credit markets seize, when banks pull back, when trust in the financial system erodes, gold and silver become the ultimate form of portable, fungible, universally accepted wealth. The data supports this. Central banks around the world added over 1,000 tons of gold to their reserves in 2025, the highest level of purchases in over a decade. China, Russia, India, and Middle Eastern sovereign wealth funds are accumulating gold at record pace. They understand what's coming, and they're positioning accordingly. For small business owners and individual investors, the play is the same. You allocate 10 to 20% of your liquid capital into physical gold and silver. Not ETFs, not mining stocks, not paper claims. Physical metal that you hold in your possession or in allocated storage outside the banking system. This is not a speculative trade. This is a structural hedge against banking system stress and currency debasement. Now let's talk about what you need to do right now. This is your action checklist, and you need to take it seriously because the window for positioning is closing. First, if you own a small business, you need to stress test your access to credit. Do not assume that your credit line will be there when you need it. Call your bank, ask about renewal terms, understand your covenants. And if you sense any hesitation, start developing alternative sources of capital now. Talk to private lenders, build relationships with hard money funds, and keep at least 3 to 6 months of operating expenses in cash outside of the banking system. Second, if you have capital to deploy, start building a pipeline of distressed opportunities. Connect with bankruptcy attorneys, monitor court filings, and develop relationships with business brokers who specialize in distressed sales. The deals are out there, but you have to be proactive because the best opportunities do not get advertised. Third, reduce your exposure to regional banks that are sitting on large, unrealized losses. You can find this data in their quarterly filings. Look for banks with high concentrations of commercial real estate loans and large securities portfolios. Those are the institutions most at risk. If you have deposits above FDIC limits in those banks, move them. Diversify across multiple institutions or move into treasuries or money market funds. Fourth, build a position in physical precious metals if you have not already. This is non-negotiable in an environment where banking system stress is rising and credit is contracting. 10 to 20% of your liquid net worth should be in gold and silver, and it should be held outside the banking system in a secure vault or in your direct possession. And fifth, stay informed. This situation is evolving rapidly. The data is being released every quarter. Loan officer surveys, bankruptcy filings, bank balance sheets. You need to be monitoring these indicators because the mainstream financial media is not covering this story with the urgency it deserves. The narrative is that the economy is fine, that the banking stress of 2023 is behind us. But the data tells a completely different story. Small businesses are failing at crisis levels, credit is contracting, and regional banks are under stress that is not resolved. The liquidity drain is real, and it is accelerating. Here's the question I want you to answer in the comments because I want to know where you stand. If you own a small business, have you noticed your bank tightening credit or changing terms in the last 12 months? And if you're an investor, are you positioned to take advantage of distressed opportunities, or are you still waiting for confirmation? Let me know, because the diversity of perspectives in this community is what makes it valuable. And if you found this breakdown valuable, if you understand why this matters and why the timeline is compressed, then I need you to do two things. First, smash that subscribe button and turn on notifications because we are tracking this crisis in real time. And the follow-up videos are going to show you exactly which sectors are failing, which banks are most at risk, and which opportunities are emerging. Second, share this video with any small business owner or investor you know who needs to hear this. Because the people who are going to be hurt the most are the ones who are not paying attention. The liquidity drain is happening now. The bankruptcies are accelerating. and the asymmetric opportunities are forming. The only question is whether you're going to recognize the pattern in time to act, or whether you're going to wait until the crisis is consensus and the exits are closed. I'll see you in the next one.